Howdy, everybody. Welcome to Liberty Call. Today is Friday, September 6th, 2024. Hope you're having a great day out there. It's a beautiful day here. It is clear skies, sunny, and a little chilly outside, which is nice. And I hope you're having a great day and headed into the weekend. So we got college football, pro football. I think they played last night. I didn't watch because I don't care about the teams. I do play fantasy football, but I really don't pay attention to pro. And see the Astros got swept by the Reds, which was excellent. I think the game was over yesterday before my broadcast, and I was steaming as I was as I was doing my show. So, anyways, before we get started, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All right, let's hop into the markets. They were not in a good mood today. Dow Jones was down 1.01%, 410 points, closed at 345. S&P 500 down 1.69%, 93 points, closed at 5410. NASDAQ down 2.53%, 433 points, closed at 16,694. The VIX was up 12.46% today. It's at 2238. Canada down 0.9, Brazil down 1.39, and Mexico down 1.09%. Headed over to Western Europe, Germany was down 1.59, the UK down 0.73%, France down 1.07, Netherlands down 1.41, Spain down 0.89, Italy down 1.17%, Switzerland down 0.98, and Portugal down a third. Pretty ugly day across Europe and the Americas. See if there's any bright spots as we go further down. Russian exchanges, let's see here, the MOEX was up 0.13%, and the RTSI was flat at 0. And the overnights, the Nikkei in Japan was down 0.62%, Australia up 0.39%, New Zealand down 0.75%. In China, the Shanghai was down 0.81%, the Shenzhen component down 1.44%, China 50 down 0.59%, DJ Shanghai down 0.81%, Hang Seng flat at looks like it wasn't open, and same with the Taiwan weighted. All right. So those were the markets for today. Let's bring up our chart and turn off my trend lines. And let's go to the week. All righty. Where'd the week start here? On the 3rd. All right. Starting out with the Dow Jones, we're going to be down about 2.84%. The S&P 500, about 4.2%. NASDAQ, 5.73%. And the Dow Transports, about 3.9%. And the utilities, that is the lone bright spot, up 0.75%. So those are the charts for the week. Let's go to zoom out of here a little bit and kind of take a peek and see what's going on. This is starting out. This is January right here, kind of sideways. A couple uptrends, couple downtrends, and we had. If we put my trend lines back in here, we had come down here and bounced off this trend line with the Dow in the beginning of August, and had a nice rally back. Did get above the previous highs, which typically would be a sign that hey, we may continue this trend a little longer, but again, knowing the external circumstances of what's going on in the world really doesn't surprise me that it lost steam and is headed back this way. Go to the S&P 500 chart, broke this uptrend in mid-July, and then had a similar uptrend, and it did not break the previous peak. So that's, in my mind, not good news. Maybe the Dow, just because it had so many blue chips, it pushed it up, and then same thing with the NASDAQ. Didn't even come within about 3% of its previous high. So, all right. So those are the markets for now, and we'll see how things go. Let's get that off the screen. All righty. Well, let's get to the economic data that came out this week. Starting out with jobless claims. And the initial claims came in at 227,000. Forecast was 231. Previous number 232. Continuing claims came in at 1.838 million. Forecast was 1.87 million. Previous number 1.86. So still below the forecast there. The U.S. Manufacturing Purchasing Managers Index, the PMI, came in at 47.9. Forecast was 48. So just a smidge below the forecast. Previous number was 49.6. So it has been trending down for about 3-4 months now. Construction spending month over month contracted at 0.3%. Forecast was 0.1% growth. Previous number was flat at 0. The U.S. trade balance, we have a deficit of 78.8. Is that billion or trillion? I guess billion here. And let's see here. Forecast was 78.8, so right on forecast. And the previous number was a deficit of 73 billion even. Factory orders month over month grew at 5%. Forecast was 4.7. Previous number was a contraction of 3.3%. The ADP non-farm employment change only grew by 99,000. Forecast was 144. Previous number was 111,000. And the U.S. non-farm payrolls came in at 142,000 in growth. Forecast was 164. Previous number was 89,000. And the unemployment rate stayed steady at 4.2%. And lastly, the participation rate held also at 62.7. All right, so that's all the data this week. I mean, I would assume that the tumble in markets yesterday and today had more to do with the jobs numbers looking so cruddy, I guess would be the word to put it. But that'd be my guess. All right, let's get into the market recap. Wall Street stocks fall. Jobs data feeds uncertainty about rate cuts. And I guess that, if I could, pause here before I start, if the jobs numbers look bad, that might tell the Fed that maybe we shouldn't do as much. Maybe we should, only do 0.25% instead of 0.5%, which everyone's wanting 0.5%. So I guess that's the feeling with the Fed meeting coming up next week is that, if things go too far in either one direction, it could really screw up what everyone thinks the plan is right now. Unfortunately, like I said in previous broadcasts, they were talking about rate cuts, going back to 22, but they were definitely talking about them most of last year, especially at the end of the year. They're like, well, definitely by March, we'll be cutting rates by March. Well, it's September 6th right now, so haven't seen a rate cut yet. All right, U.S. stocks fell on Friday, weighed down by disappointing jobs data reports and uncertainty over the Federal Reserve's next steps regarding interest rate cuts. The S&P 500, Dow Jones, and NASDAQ all posted losses, with the S&P 500 and Dow set for their biggest weekly drops since March of last year, 2023, and the NASDAQ facing its largest decline since January of 22. The U.S. Labor Department reported that employers added 142,000 jobs in August, below expectations, with the July jobs report also revised down to 89,000. The slowdown has led to speculation that Federal Reserve Chair Jerome Powell will be forced to cut rates, but concerns are growing that these actions may come too late to avoid a recession. Lou Bassanese, chief strategist at MDB Capital, suggested that potential layoffs in the coming months could indicate that Powell's timing was delayed, potentially leading to the Fed to cut rates by 50 basis points instead of the expected 25. They should just leave stuff alone. Let rates set themselves on their own. Let banks and lending institutions determine what the going rates are based upon the economy. If things get if write-offs get too high, or charge-offs or delinquencies get too high, then you raise interest rates. You punish the people that, have bad credit. And, you also reward the ones who pay all their bills on time. That's just the way it's always worked. Let's see here. Fed Governor Christopher Waller signaled the likelihood of rate cuts, though traders remain divided on the scale of the reduction. Current bets indicate a 73% chance of a 0.25% cut, while a 27% expect a 50 basis point cut. Tech stocks led the declines, with NVIDIA, Tesla, Alphabet, Amazon, Meta, and Microsoft and Apple all posting losses. Broadcom shares fell 9.7% after forecasting lower than expected revenue, contributing to a sharp decline in semiconductor stocks. The Philadelphia SE Semiconductor Index experienced its largest weekly drop since March of 2020. All right, so good stuff. Let's hop into a data report here. August employment report via First Trust and Mr. Robert Stein, Deputy Chief Economist there. All right. The Federal Reserve is expected to begin cutting interest rates on September 18th, with today's labor market report suggesting a 25 basis point cut instead of 50. Although job growth continued in August with 142,000 new non-farm payrolls, Payroll jobs revisions to June and July data lowered the net gain to 56,000. A core measure of payrolls, excluding government, education, health services, and leisure sectors, showed only a 25,000 increase in August and just a 31,000 total over the past 3 months. Despite mixed jobs data, civilian employment, which includes small business startups, saw its largest gain in 5 months with 168,000 new jobs. However, civilian employment is still down 66,000 compared to last year, with full-time employment declining by 1 million. On the other hand, payrolls have increased by 1.9 million over the past year. Sounds like a lot of government jobs. Those aren't real jobs. It's daycare. A positive aspect of the report was the 0.4% increase in average hourly earnings, up 3.8% annually, outpacing inflation and providing more purchasing power for workers. Additionally, total hours worked rose by 0.3% in August and 1.1% increase over the past year. With the economy and inflation decelerating, the Fed is expected to continue rates at its future meetings. All right. So it looks like, all the smart people that I seem to listen to and have respect for, the folks over at First Trust, they seem to think this is definitely going to happen next week. So I guess we could place our bets, a little further across the 50% mark. That they'll, again, as much whining and crying as there has been in the financial journalist space, begging for rate reductions. I have to imagine most of these people, crying and moaning about have no idea what it really does in the big picture, but hey. All right, one last article here from the Mises Wire, titled "Kamalanomics: More Inflation for America," written by Daniel LaCale. All right, in a recent CNN interview, Kamala Harris praised Bidenomics and claimed success in reducing inflation. However, since the Biden-Harris administration began in January of 21, inflation has risen by over 20%, according to the Bureau of Labor Statistics. Harris and other Democrats have blamed external factors like war. Well, easy to stay out of that. Quit sending bombs and missiles and all that stuff abroad. I mean, easy. Where was I? The pandemic. Again, it was a cold and we didn't have to shut everything down. And supply chain disruptions for rising prices. Well, again, those supply chains wouldn't have been disrupted if America hadn't freaked the rest of the world out. When inflation dropped, Harris took credit despite previously blaming corporations and grocery stores for price hikes. Yeah, this is somebody who's never had a real job and doesn't understand how the market works. Daniel LaCale argues that inflation is driven by government policies. I agree, particularly excessive money printing, definitely, deficit spending, and regulations that stifle competition, all perfect examples. He claims inflation is a hidden tax that shifts wealth from the private sector to the government while making citizens more dependent on government subsidies. In this context, LaCale criticizes Harris's economic policies, asserting they perpetuate inflation to mask the growing government debt and deficits, which have ballooned to $1.5 trillion in the fiscal year and are projected to add $16.3 trillion from 2025 to 2034. If you think the United States is still going to be around by 2034, you've got another thing coming. And to finish up here, LaCale believes Harris's economic plan mirrors Argentina's socialist model, where government spending and money printing devalue the currency, ultimately reducing purchasing power. He argues that Harris's approach seeks to expand government control at the expense of the productive sector, which he believes will erode the U.S. dollar's global standing. Will? I think it already has. I mean, the U.S. dollar is not worth anything these days. I mean, granted, compared to the British pound and the euro and all the other ones, I mean, all these central banks are guilty of, inflating their currency to, mask over all of the, government spending and problems that they've created. So anyways, all right. Well, that's everything they had for today. If anyone needs anything from me, such as getting your financial plans back in place, go to DSAFinancialGroup.com. All your financial planning needs can be addressed right there. All right. Well, hope everyone has a fantastic weekend. Get outside. Get some sun. I got some chores I got to do. And, now that it's not that it gets hot here, but, you spend several hours outside in the sun, it does beat on you a little bit. So anyways, hope everyone out there has a great weekend and I'll talk to you next time. Adios.